5, and my name's Drew.
I'm Christina.
I'm Ridge.
And I'm Barbara.
Today we're going to talk to you a little bit about financial statements. We have the small business owner in mind who hasn't had a lot of business school classes, so we're going to keep it fairly simple, and a few things we want to touch on are: first, what are financial statements? Second, how are they used? And third, why they'd be useful for a small business owner. First, give you a little bit of background on financial statements. We interviewed one of the senior lecturers here at Texas A&M, and so now we're going to go to Ms. Cassidy.
Well, financial statements represent the financial position of a company. A corporation, if they're trading their stock publicly, they're required to report at least annually for their financial statement users. And it's to, again, just give the financial performance for that period of time, for how, basically to tell the story about the company. How did they perform?
So could you tell us a little bit about each one of the financial statements and how it might be used specifically?
First, we have the income statement, which is revenues minus expenses equals net income.
Starting with the income statement, normally the income statement, you're going to start to analyze a company's overall profitability. In order to do that, the very first line item on an income statement is going to be your revenues, the primary source for where that company, what they engage in doing every day in order to stay in business. The income statement also includes other components of income that a company may or may not engage in every year. So they have irregular items within there. And so you want to know exactly, if you're trying to forecast where that company is going in the future, you want to stop with their operating income, because that indicates what they're engaged to do every day, not only this past year, but what they will in the future as well. So different components tell the necessity of what happened to the company in this current accounting period, but not necessarily what you can rely on to happen in the future.
From the income statement, net income flows into the statement of stockholders' equity. The statement of stockholders' equity is beginning retained earnings plus net income minus dividends equals ending retained earnings.
In terms of the statement of stockholders' equity, this one is going to look at the owners, what they have contributed to the company over the time, what the company has reinvested in itself. There are other components that bypass your income statement that would only appear within your statement of stockholders' equity. And so for those other comprehensive income items, you definitely would want to do an analysis of your statement of stockholders' equity to identify those kinds of transactions that occurred within the past year. For example, you have a lot more companies that are international companies that have to deal with foreign currency, and so when those statements are brought together, that would be an OCI item that would definitely be disclosed within your statement of stockholders' equity. That would be, you would simply want to look at what those translation adjustments have done from the prior year to the current year, and how that is affecting the overall equity of the company.
Ending retained earnings on the statement of stockholders' equity flows into the equity on the balance sheet, and the equity plus liabilities equals assets on the balance sheet.
Your balance sheet then is going to show your financial position in terms of gaining any information from your financial position. Your assets always have to equal the sources of your assets. So you're going to look at leverage. How heavily is this company in debt? How much did they use debt or equity to acquire those resources? You're looking at the risk of a company when you're looking at your balance sheet, the financial position, the leverage. You want to look at their ability to pay not only their short-term debts when they mature, looking at things like your liquidity ratios, but those long-term solvency ratios as well. Other areas of risk that you would want to look at Oftentimes, items will never show up in your balance sheet, but they do indicate an assessment of risk against the company pending lawsuits, changes in the environment. So you would also want to read the complete set of footnotes for anything that might not actually be disclosed as a singular line item on your financial statements themselves. You can have a lot of information that are required footnotes within the contents of an annual report, and that's a necessity to gauge the overall picture of their financial position.
The cash flow statement has beginning cash plus or minus changes in cash equals ending cash, which then flows into the cash balance on the balance sheet.
In terms of the statement of cash flows, it's probably one of the most critical statements because we all know that it's cash that keeps the company viable and moving forward. It is completely different. Many students, when they first start looking at financial statements, they get it confused with, well, why do I need an income statement and a statement of cash flows? And it's telling you something completely different. If you understand the rules of the game, you understand we're following accrual-based accounting, and that is based on the timing of when do we earn revenues, when do we use up an expense. That's what indicates when it should be reported within our income statement. But the actual timing of the cash received or the cash paid is what's going on your statement of cash flows. And so you can get a better idea of how capable this company is of paying their debts when in a timely manner, or do they have to go to the bank and take out a loan in order to pay their operating expenses. So there are indicators of other risk areas there if you look at all four of the financial statements combined. Well, in order to get a full picture of the financial statements for the performance of a company, you have to look at the entire package of information that's being presented to you. Financial ratios, there's a lot of relationships that exist within the financial statements, and to really get a good understanding, there's not one ratio or another that will tell singularly the story of that company, but collectively, if you look at all of it in its entirety, you've got to read the footnotes, you've got to understand the rules under which it was presented, and only then can you make an informed decision that will tell you the story about what happened to the company. How well did they perform? You want to know not just within that company over the trend for that particular company over the last couple of years, but you also want to compare it within their operating environment. How do they stack up against the competition? And then you can start to project where you think that company might go in the future in terms of their longevity, their ability to compete in a changing market. Well, a small business owner is not exempt from having to go to the bank and take out a loan, or trying to deal with their suppliers to get their goods delivered to them and have a reliable supplier that is willing to do that. And all of those other parties, those external users, are going to rely on that company's financial statements in order to gauge that small business's ability to repay them in a timely manner. And so any of those, if you're looking for a small business loan, if you're simply looking to expand your suppliers for growing a market, they're going to rely on that financial information in order to base a decision whether or not to do business with you in the first place and to help you grow in that manner. Well, hire an accountant, most definitely. I had an opportunity in my past to work for a small business owner, and I just simply kept the books. I would do all of their general record keeping, their payroll, but they had an accountant that they worked with quarterly because they had to quarterly pay taxes. They were, at year end, they were required to prepare financial statements and submit that to their banker to continue to have the lending agreements intact and moving forward. So I would definitely work with an accountant from the very beginning in setting up your information systems. There are a lot of software that's available for a small business owner that is very easy to use. It's very user-friendly, and in the end result will help that accountant at the end of the reporting period to bring that information together and to very quickly explain it to the business owner why that's a necessary part of their operating system. And it's a very good first step.
Thanks, and Gig 'em.